and today we're going to be talking about a deep dive into business credit reporting. We're going to break down business credit scores, all the different ones out there, what's available, what to look for, how to just understanding what banks are looking at, what lenders are looking at. So before we dive in, we've got a couple quick things happening this week. Actually, a couple huge things. First off, actually, right now at this very moment, we've got the Funding 30 Challenge happening, which, if you're not familiar with it, the Funding 30 Challenge, we have over 20 different speakers lined up for the week. They're coming in and presenting over 30 different topics on funding, different options, whether it's business credit, lines for credit, commercial real estate. I think we're talking about gig financing today. Lots of really cool things going on. This video will be left on our page, so you can come back and watch this. The Funding 30 Challenge is just kicking off right now for day 2. We've got a full 5 days, so it's going on until Friday. So definitely something that you want to jump into if you're interested. You can check that out at creditsuite.com/funding, or you can go to funding30challenge.com and register there. So funding30challenge.com is a great place. You can go register. We'll get you access. You can get in and take advantage of all the awesome training that's going on there. So if you haven't done that, get over there. It's going to be awesome. It's already awesome. We already got people getting money for their business, and it's one of our most powerful events we run. So let's jump into the meat and potatoes today. Today, we're going to be talking about business credit reporting. And we're going to be specifically diving in on business credit scores, how they work, what you need for them, just understanding the ins, the outs, all the ups and downs. So there's a couple that we're going to look at. First off, we're going to look at Experian. We're going to look at FICO, or specifically the FICO SBSS, which is specific for SBA loans. We're going to look at Equifax. The reason we've got these broken down, because all of these report to both consumer and business credit. So it pulls from different factors. It pulls from your business credit report and your personal credit report. But then we're also going to jump into Dun & Bradstreet only reports that only report on business credit. So different scores there are different scores on different reports. It's important to know this. It's kind of like on your personal credit, you could look at a Vantage score. There's what are the different models? You've got Vantage score, you've got FICO, there's a Advantage score. There's a lot of different options out there right now on the personal credit side. On the business credit side, it's a little bit different. Like on the personal credit side, you've got a lot of the businesses out here, a lot of the credit scores that are out there are actually they're going to show on the personal side. Sorry, they're owned by a third-party company. So FICO is actually owned by the Fair Isaac Corporation, where when you're looking at business credit, the business credit scores and the business credit reports themselves are oftentimes owned by the same companies. And as we get into it, you'll start to understand why and how this impacts you. So first thing to understand is D&B has a Paydex score. That's what they use to score their credit reports. So if you're looking at it, you're going to be looking specifically at a Paydex score. Experian has one that's called the Intelliscore, and these are really your two primary credit scores when it comes to business credit, is your Paydex and your Intelliscore. Equifax has one. Equifax actually hangs out closer to the Paydex model and works with that. Some of the other scores, and there are other scores like D&B Supplier. Honestly, guys, while I was doing the research for this, one of the fascinating things that I found, there are over 50 different credit bureaus that are out there, 12 different categories, all of them collecting information on you. All of them have data on you, and that information is sold and transferred and reported. So, and when you're keeping this in mind, you have to also keep in mind that a lot of these scores that they're coming up with it's a product. They're creating these scores as risk indicators for the people buying the data. So, for example, D&B supplier evaluation risk rating means somebody who's a supplier is going to have a different score than somebody who's maybe a consumer. So, like if you want to have trade accounts, you want to have supplies that you're offering as a vendor, you're going to have a different score than if you're a consumer using a vendor account. So as we're going through this, some of this is just fun information, just things to keep in the back of your mind. and understand just how the system really works. D&B suppliers supplier stability indicator, the SSI score, which really focuses on how stable a vendor is, which is very important if you're looking for a long-term relationship. You can kind of find out the financial history and the financial security of a supplier that you're working with. Other scores, again, Equifax has a small business credit risk score for suppliers. That small business risk score is lines very closely with Paydex score. Equifax's business failure score, and then with Dun & Bradstreet, you've got the Paydex score. Oh, sorry, different thought here. So Equifax has a business failure score it's going to predict, and we're going to jump into all these. So let's start with the big one. Dun & Bradstreet has the D&B Paydex score. The Paydex score ranges from 0 to 100, which I absolutely love, just because like when you look at like FICO scores and you're looking from a range from 350 to 800, it's just kind of ambiguous. You know, it's out there. You've got this big number. That's cool, but it doesn't really tell you. And I like the 0 to 100 model because it's just like a report card. You can look at it and go, I got an A, a B, a C, a D, or you know what, my credit is failing at this point. And it's a very familiar model. 100 is the best. 0 is going to be the worst, and that's just pretty common sense there. So what is a good Paydex score? Paydex score of 80 is what you need to get the most favorable financing. So an 80 Paydex score should kind of be your goal, and it doesn't take long to get there. It's actually a pretty quick path, and we'll go over what you need to be able to qualify or to be able to get your scores there. But the Paydex score is 80, and a lot of times, as long as you've got 5 or 6 accounts that are reporting, you have consistent payment history on there, getting to that 80 isn't as difficult as it may seem. And basically what it's doing is it indicates that your business pays all its bills on time. It's really simple, general overview, but business credit scores are going to function different than personal credit scores. Personal credit scores are, well, let's dive into that for a minute, because I think that this is something that I actually find incredibly fascinating. When you start comparing the difference between a business credit scoring model and a personal credit scoring model, there's 2 different factors and 2 different mindsets that go into this. So the first thing to understand is with a business isn't on a set fixed income. For a consumer, they're assuming that most consumers are going to be on a fixed income or a stable income. So if you're making $100,000 a year, it's not likely that you're going to jump up to $200,000 in a single year. It's possible, but it's not likely. But with a business, it's very possible to go from $100,000 to $200,000 in a year. So a lot of the factors like the debt ratio, looking at how much you're borrowing opposed to what your credit limits are, don't have as much of an impact on the business models because they understand that the business can generate revenue a lot faster, has a lot more cash flow. So what they're looking at is the responsibility of how you manage those relationships. Are you paying them on time? That's really their big concern is are you making the payments? And from there, when you keep that in mind, it helps to understand a lot of what they're doing. So your Paydex score is basically, it indicates that the business pays all the bills on time. To be able to get to that 80 Paydex score and to actually get any score reporting on Dun & Bradstreet, you need to have at least 5 trade accounts that are reporting to the business file, to have reporting to the business reports to have that Paydex score. So if you don't have 5 accounts, if you don't have 5 payment experiences, if you're not making payments, there's nothing to report. And it's pretty common sense, because if you have a credit account and you open it but you're not using it, there's really no data there. And if there's no data there, there's nothing to score it off of. So Paydex looks at it and goes, you know what, we're not going to just jump to conclusions because you have 1 payment on there. They want to see 5 accounts. They want to see good payments. They want to see some consistency in there before they're going to issue you that your Paydex score. Now, with that Paydex score to get to 80, you can actually quickly get there with just those 5 trade accounts or with those 5 vendor accounts. It's not difficult to get there, and it's not really difficult to maintain. It's just understanding how the system works. Some of the other details about Paydex. They have a weighted average, which means Paydex is going to give more weight to a trade account that reports higher amounts of credit extended. And not just higher amounts of credit that's extended, but also higher use of those credit. If you have an account that's got let's say you've got a $5,000 credit limit on it, but you're only spending $50 on it, it's not really showing the stability, the financial stability of the company or your ability to make those repayments. So that's something to keep in mind as you're working on building your business credit. Find accounts that you can actually use. This is something I tell you guys over and over and over again. I'm going to drive it home as much as I can. If you're not using it, it's not going to provide value. So when you're using that, Paydex is going to look at the ones that have higher amounts, that have more credit available, and that's really where a lot of that weight's going to be extended for. And it gives less weight to trade accounts that report lower amounts. Kind of makes sense. It's the opposite, it's the inverse there. So pay the biggest one first to keep your score up. And I mean, while you're at it, just pay all the bills on time. It just makes everything go by a lot smoother. So let's talk about the D&B supplier risk evaluation. The supplier risk evaluation rating predicts the likelihood of a company that predicts the likelihood a company will file for bankruptcy and cease operations within the next 12 months. This is a big one for banks. Because what they're looking at is they're looking at a lot of the underlying hidden factors. Are there judgments out there? Are you missing payments? Are you consistently missing payments? Are you falling behind on your obligations? Is your cash flow down? These are all indicators that D&B is taken into consideration with this risk evaluation. And their whole goal is to predict the likelihood of you going bankrupt or closing down the business. And if you compare that with the FICO scoring model for your personal credit's trying to determine the likelihood of you going delinquent within going 90 to 120 days delinquent. The reason they're looking for that is because historically, if you go 90 days delinquent, you've got a 75% chance of the account being charged off and the bank losing money. With the business credit side and the business lending side, they're looking at it from the standpoint of it may be charged off, but if the company goes bankrupt, if it ceases operations, then they're going to lose all that money as well. So they're looking at it more from the ability to maintain operations within 12 months. Scores range from 1 to 9. It's very simple. So 1 being the lowest, 9 being the highest. Obviously, this is something that you want to shoot for a 9. And now, one thing to keep in mind is when you're looking at some of these scores, these aren't scores that you can necessarily manipulate. These aren't ones that, like with business credit, that if you get out there, like what we just talked about, if you get out there, you start making payments on it, it's going to show up, and you're gonna boost your credit score. With a supplier risk evaluation, they're taking a lot more information into consideration, such as cash flow, what trackable expenses are available. They've got all these different options that they're going to compare. So this score isn't really something that you can manipulate. It's not something that you can impact outside of just running a healthy business. And some of these things that they're going to look at is they're going to look at checking accounts. They're going to look at if you have reserves, what your cash flow looks like, if you're overdrawing your account. So it may take check systems and some of that other data into consideration with it. So let's talk about the D&B supplier stability indicator. This is going to predict the likelihood that a supplier will encounter a large and significant financial or operational stress over the next 90 days. This one's actually going to be a little closer to like the FICO scoring model. What's the likelihood of you not being able to pay your bills within a 90-day window? That's what the supplier stability indicator is looking at. And again, it's going to give you a range from 0 to 10, 0 being the lowest, 10 being the highest. And again, this is not something that you can necessarily control outside of your just cash flow, your operations, keeping the business running, keeping it stable, having a healthy balance sheet, making sure you've got assets, making sure you've got reserves, and just being financially, fiscally responsible with the business, and prepare for hard times, prepare for the recessions, prepare for economic downturns, just prepare for anything, because your business, it needs revenue just like your family does. So that's some tips there. For Experian Commercial, the reports are going to include your payment history. Obviously, anytime you look at a credit report, it's going to show the information, who you're making payments to, how much you owe, what the credit limits are. They're going to put a lot of weight on that payment history. and they're going to be checking out your public records. Do you have any judgments out there? Are there any liens? With those liens, they're also going to include the UCC filings. So these are really the three primary components of the Experian Commercial reports, what they're looking at. There's other factors that go into it. They will keep track of like your high credit limit, the date of last activity. They're going to look at obviously payment history, but they're going to look at how often you're making those payments. It's going to have a lot of the same data that the personal credit bureaus have. Now, anytime that you're looking at a credit score, anytime you're looking at the data, one thing to keep in mind: the credit bureaus have so much information on you that it would absolutely blow your mind. There's companies that you can buy 400, 500 different data points on a consumer just from lead generation. People can go out and buy leads. You can purchase this data from the credit bureaus, and it's just got a ton of information on it. And what the credit bureaus do is they're selling that information to businesses that are looking for marketing, they're looking for mailing lists, things like that. So they're collecting all this different data. But when it comes to the actual report and it comes to the scores, they're repressing some of that back. So understand that they may have a lot of information on you that not necessarily showing up in your credit report, but it's still available. And it's something that they're not going to use in the weighting of their scores, but they do collect that information and they do retain that information on you as well. The score model that Experian uses is called Intelliscore. The Intelliscore is their personal proprietary scoring system, which means Experian sat down, they looked at their algorithms, they came up with this formula to be able to come up with the Intelliscore. The scores are going to range from 0 to 100. So again, it's following the D&B model of like a report card. The percentile score compares to other businesses. So part of what they're looking at, the new Intelliscore it has over 800 factors that are affecting it. But part of those factors is it's comparing you to other businesses that are out there in your industry that may be sharing your NAICS code that are similar. So, for example, if they see that you open a trucking business and just instantly within 6 months you're now running a $50 million company over a 6-month period, they're going to compare that to other companies that have been in business for 6 months, and it's going to base the weight off of that. These are all some of the factors that are looked into, because again, as much as we want to care about our business credit scores, personal credit scores, any of them, credit scores aren't made for consumers. Credit scores are made for banks. Credit scores are a financial tool that are sold to banks. On the business credit side, anytime you're looking for insurance, they're looking at your business credit scores. Anytime that you're applying for any type of business lending, whether they tell you or not, they're still looking at your business credit scores. SBA leans on it heavily. If you're setting up vendor relationships, or if you're setting up retail relationships with a company like Walmart or Target or any of the big box stores that you have products that you'd like to get supplied in there, they're going to be looking at your business credit scores. The credit scores are designed for the people who are working with you, not for you. It's not an indicator for you. It's actually more of an indicator for people who are looking to work with you. So let's talk about Experian's model. For Experian's model, they're going to put each business into one of 3 different models. The commercial models include small business, a medium-sized business, or larger businesses. Small business, maybe 1 to 5 employees. Usually, you're ranging down from about $2 million below. Medium businesses are looking at $2 million in revenue and above. And then larger businesses, these are more going to be corporations, publicly traded. These are going to be just massive amounts of money. They're going to be running maybe millions and millions of dollars, hundreds of millions of dollars while they're classifying you. And then it's going to take a blended owner model, which the commercial data is linked with the owner's information, meaning that Experian has no problem looking at your personal data, comparing that with your business data, and then blending it and making it where they're letting banks make an informed decision, especially when they're looking at the personal guarantee side. Now, the interesting thing about this is if you're comparing. If you really want to compare the difference between the Experian model and the Dun & Bradstreet model, Dun& Bradstreet really focuses a lot on the business credit side, where it's more about the vendor relationships, it's more about that side, where Experian is going to focus a lot more heavily on like the SBA and the traditional banking loans that are going to require a personal guarantee. So when you see that blended owner model and you see that they may be comparing your personal credit scores and factoring that into your business credit scores, you have to understand the data that's being sold. They're selling that information to banks that are looking for a personal guarantee, for SBA loans, for traditional lending, for banks. That's why they're doing this, is because it fits the model that the lenders are actually looking for with it. And the Intelliscore Plus is a percentile score. So it's going to base everything that you're doing off of a percentage of what you're doing. So the Intelliscore Plus is based on payment history, but there are other factors that go into it. Again, they're looking at over 800 pieces of data, points of data with it. It's going to look at historical behaviors like payment history. Historical is going to be the length of credit. It's going to be how long you've been making payments on it. It's going to be, are you consistently making payments on it, which is going to constitute 5 to 10% of your score. Current payment statuses or trade balances and percent of accounts that are delinquent are going to make up 50 to 60% of your score. Again, making sure your payments are being paid on time, it goes to 50 to 60% of your Experian score as well, your Intelliscore. It's also going to look at credit utilization, which on the personal credit has a massive impact. On the business credit model, it's not as much, but they still are looking at it and taking it into consideration, which can equate to 10 to 15% of the total score. And again, keep in mind, this is the Intelliscore. This isn't Dun & Bradstreet. This isn't your Paydex score. This is really just comparing the data or understanding the Intelliscore side. And then the company profile is going to be looking at the age of the business. It's going to look at the risk factors. It's going to look at the size of the business, and it's going to be assessed by the number of employees. And that's going to take up 5 to 10% of your scores. Why is that important? Because traditionally, if a company is larger and it hits a financial downturn, there's a lot more resources to be able to maneuver around. If you have 100 people employed and you just hit an incredibly bad rough patch, it's much easier to scale back, keep the business intact, fulfill your financial obligations, do what you need to do, recoup, rebuild, and move forward. Opposed to a small company where it's just you. If you hit a financial downturn, it could end the business and it could cease operations. So that's part of their mentality when looking at this. And then the last 10 to 15% is going to be a total score based on the derogatory items. So if you're missing payments, if there's collections out there, if there's charge-offs, anything like that, any repossessions, any derogatory information is gonna have a 10 to 15. It's gonna impact 10 to 15% of your total score. Whew, we've come through a lot of information. We still got a lot to cover here, so hang on with me here. So let's talk about the data on your Experian credit report. So how long is that information going to actually stay on your Experian credit report? Bankruptcies are going to stay on 9 years and 9 months. We're going to round that up. We're going to call it 10 months. The reason it's 9 years and 9 months is because there's actually that 3 months that it goes into charge-off status, which makes it just kind of around 10 years. But if you look at their information, if you look at what they actually do, their guidelines, it's 9 years and 9 months. A judgment and a tax lien is going to be 6 years and 9 months, so basically 7 years. Collection is going to be 6 years and 9 months. Again, that 7-year window. Uniform commercial UCC filings have a 5-year window on them that they're going to show up on your business credit profile. Bank and government leasing data is 36 months, so it's got a 3-year history. That's important to keep in mind. Business credit, again, it's all about who are you paying right now, how well are you paying them. There's not a big history there, so it really limits it to about 3 years worth of data. And trade data is the same thing, 36 months or 3 years. So let's look at the Equifax Small Business Credit Risk Score. The Equifax Small Business Credit Risk Score is going to predict the likelihood of greater than a 90-day delinquency or charge-off on a financial service over the next year. How likely are you to go delinquent on your business credit accounts? That's really what Equifax is looking for here. It's going to use financial services and trade payment data, and it's going to range from scores range from 101 to 992. So there's a little bit of a larger range in there, but that's okay. It's their score; they can do what they want. And again, it's gonna be looking at it's gonna predict the likelihood of failure from bankruptcy within a 12-month period. It's also built using financial services such as trade payment data. Looks at your spending habits. It's going to look at trends as well. If it sees that you have a year of making payments on time and consistently using your credit, and then all of a sudden you stop using your credit, that's a trend that it's going to take into consideration. Because think of it this way: if you have payments, you're making payments. Now they can track and they can see, okay, you know what, they're making money and they're spending money and they're spending it responsibly. If you stop making those payments, there's nothing left for them to judge. There's no data there. They don't really have anything that they can use for it. These scores are going to range from 1,000 to 1880 with the business failure score. If you ever want to know why they have such weird ranges, it's actually pretty simple. Equifax on their credit reporting ranges from 0 to 100. On the small business risk score, it goes from 101 to 992, and then we go over to the business failure score. It goes from 1,000 to 1880. So if you look at it and you compare them side by side, you really just start to get the sense of we ran out of numbers at 100. Let's go to the next. Let's go to the next batch of numbers. That's really why their scores are based the way that they are. All right, let's jump into a big one. This one is going to have a different life all to itself. This is the FICO SBSS score. The FICO SBSS score is an exclusive score that banks are looking at when you're getting approved for SBA loans. So it's going to have a lot of different factors included in the SBSS score that's not necessarily considered when you're looking at just your financial risk score or your failure scores or anything like that. So it's used by SBA, and it reflects the likelihood of an applicant paying their bills timely. The score is going to range from 0 to 300, and a higher score means a lower risk, just like all of our scoring models that we've talked about so far. The higher your score you have, the better it is. FICO SBS have personal and business credit history plus financial data that goes into the total score calculation. This is important to keep in mind. So when you're looking at an SBA loan opposed to like an alternative loan, cash flow lending, credit line hybrid, any programs like that, SBA is looking at the owner's information. They're looking at the stability of the actual business owner as well as the stability of the business. So it's taking the personal credit history, it's taking your business credit history, plus the financial data from the business and the financial data from you personally that's going to go into the total score calculation. The reason this is so important and the reason that we're so passionate about business credit is because if you have more on business credit, if you have a higher business credit score, it's going to take away from the impact and the impact that your personal credit is having on your SBSS score. It plays a major role in it. The better, the stronger, the more healthy your business credit is, the less of an impact your personal credit has. And it's the same thing with the financials. The stronger the business financials are, the less impact it has personally. And it can get to the point with the financials and with the credit that they're more just looking to make sure that there's no outstanding risk out there. That's why with SBA, they've never come out and said you have to have a 720 score and X amount of factors into it, because there's so many different varying factors that go into it. And so that's what makes this SBS score complex. And again, the magic formula for making this work: have great credit, have great cash flow, have great personal financials and business financials. That's really the key to all of this. So the FICO SBS scoring range is you need to have at least a 140 to get an SBA approval. Again, there's a lot of different factors that's taken into consideration, but typically the cutoff is as high as 160 is mostly what it's going to go up to. For the FICO SBSS scoring model, personal and business credit, it's looking at your personal and your business credit information. It's also looking at your years in business, because a more established business that's been around for a little bit longer, that has financial data on it, is actually going to show more stability with that. I just clicked around and messed some stuff up. Hold on. Okay, and it's also going to look at financial details such as the cash flow of the business, what the revenue looks like. It's gonna look at the it's gonna look at your spending, which is why they're looking at your that's why they're looking at your credit score. It's going to look at your balance sheet. It's going to look at your profit and losses, and all of this is what's going to be culminated into the score that's going to tell SBA whether you're approved or not. And for the SBSS score, it's going to range from 350 to 850. Credit issuers can get different combinations of data as well to evaluate the risk of business. Again, these are scores. This is something I find incredibly fascinating. If you ever have a chance to sit down to take a banker out to lunch or to talk with somebody in the banking industry, this is actually really fascinating. When they sit down with the credit bureaus and they're looking at the different scores, it's not something that they just give them and say, hey, you're going to have this SBSS score, and it just is what it is. It's actually very customized for each and every bank. So what they're looking at is they're saying, okay, you know what? If their business credit profile looks like this, we're going to put a lot less weight on their personal credit profile. You may have some like super conservative banks who go, you know what? If their personal credit looks like this, we're not going to worry as much about their business credit. Or if their revenue's up here, their credit can be down here. Or if their credit's up here, their revenue can be down here. So it's all depending on the risk tolerance and the appetite of the bank for how much risk that they're willing to take. But that's part of what they're doing when they're going to the credit bureaus, when they're getting these scores, is they're going to the banks and saying, look, this is what we need from you to be able to establish a good score. And then the FICO SBSS model, FICO is actually going to come in. They're going to set up the weights according to that. So as they're getting the scores, it's very customized to each of the individual banks that are buying those services, which is part of how they make their money, because they're giving custom risk reports to the banks and lenders based on what the banks tell them that they need for it. And so it's going to be looking at a combination of that. That combination of data can be just it can be just Paydex, it could be just Experian, it can be Paydex, Experian, it could be Equifax. They could look at everything. They can choose to look at nothing. That's their right, because it's their money that they're loaning. If there isn't enough data, though, SBSS uses the business owner's personal data. Again, it's that weight factor. If the business is set up, if your fundability is intact, you've got your cash flow nailed down, you've got everything in order. The business has great business credit. It's going to not worry as much about the business owner's personal information and what they're going through. All right, so we've covered a lot of information. Business credit reports going to be different than consumer credit reports. As you can see, we just filled up about 30 minutes worth of information, just going over about 3 or 4 different scores here. Different reporting agencies offer different scores. Now I hope you understand why. And anytime you're looking at your credit scores, that it can help you just. One of the big things to keep in mind is when you're looking at your business credit scores, you're looking at your personal credit scores, it's understanding that you're looking at a snapshot in time. You're looking at something that the banks are looking at, going, we want to see this data, and then we want to take this and we want to weight it accordingly. So anytime you're looking at any sort of score, that's the information and the data that the banks have requested to receive to be able to weight it. So you're always going to have different credit scores, whether it's personal, whether it's business. There's no way obviously you can have the same scores across multiple bureaus or have them pulled from different ways, but you're going to have way more. That's why you're going to see a variation. If you go from one bank to the next, is because they're requesting different data with different weight from the different scoring models. And there's a lot of factors that affect business credit scores, but the main one, and this is just hands down the easiest way to keep it in mind, make your payments on time. If you pay your accounts on time, that's how you're going to build business credit. And the number one secret that I can tell you about this is again, if this is your first time joining, you're going to hear this. If you've been with me on some of the other ones, adopt a credit first mentality. Don't use credit as you can use credit as funding, you can use it as financing. But when you turn it into part of your financial system, when you turn it into a part of your accounting, you're using it every single month. You're using it as much as you can. That's some great payment information that's going on there. So when you're looking at getting loans, now they can verify through a third party, an unbiased third party, that is now keeping track of all of your records, and they can verify that information. Make your payments on time, set up a portfolio, use your credit, because again, it offers a snapshot in history that you don't have to go to a bank. You don't have to go to them and say, hey, I pay all my bills, I promise. You can say, nope, I pay my bills. Dun and Bradstreet says so, Equifax and Experian, and my personal credit says so. So those are some of the factors. Some of the big points to keep in mind with this. If you enjoyed this, if you got a lot out of it, I appreciate you guys commenting and being engaged with me today. If you like this, share this with hashtag business credit toolbox. And just by doing that, we're going to give you 5 free tools to easily, quickly build your business credit that's not linked to your personal credit, just for sharing the live stream. So if you need those tools, we'd love to help you out. And if you have any questions, reach out to us. We'd love to help. You can message us. You just go to our profile, hit message. Our chat's available on all of our platforms. You can comment. You can give us a call at 877-600-2487. Email us at info@creditsuite.com, or just go to creditsuite.com. We would love to help you out any way we can. And keep in mind, we've got the Funding 30 Challenge going on right now. A lot of really cool things going on. I know we've got people talking about lines of credit today, gig financing for some of that, for some of you gig workers out there. Just a lot of really cool things. You can find out more about that at funding30challenge.com, you can. That's really the best place for it. So until next time, have a great day, and we will see you later.